Ever wondered how pro investors grow their money without gambling on a single stock? Or why they talk so much about things like diversification and correlation? Today we're breaking down the basics of portfolio management and showing you how a little math can go a long way in reducing risk and maximizing returns. Let's dive in. Portfolio management is the art and science of deciding what to invest in and how much to invest in each asset. It's not just about buying a bunch of stocks. It's about building a strategy that matches your financial goals and how much risk you're willing to take. For today's video, we'll zoom in on the quantitative side of portfolio management, where math meets money. The two big goals: maximize returns, minimize risk. Now let's define a few things real quick. Return is the percentage gain. You can get it by dividing the current price by the past price minus 1. We've talked about this before. And like before as well, risk in this context is measured by standard deviation of returns. Basically how uncertain or volatile the returns are. There are other definitions of risk, but this is how we'll use it for today's video. If you've seen our value at risk video though, this should sound familiar. If not, check it out. It's the foundation for what we're about to build, especially as we will assume that you're already familiar with matrix operations, etc. Now, a key assumption we're going to be using here is that we're assuming that investors are rational. That means if two investments have the same risk, investors will choose the one with higher returns. Or if they have the same returns but different risks, they'll go for the one with lower risk. Sure, real people aren't always rational, but for the sake of learning the math, we'll use this model here. Let's revisit our example that we've used before. You're looking at 4 investment choices: stock A, stock B, stock C, and a diversified, equally weighted portfolio of all 3. Which would you pick? Well, if you only care about returns, stock C looks great. If you hate volatility, you'll probably pick stock B. But what if you want to consider both returns and risk? Well, we need to talk about the coefficient of variation, or CV, which gives us risk per unit of return. It's calculated as the standard deviation divided by the mean return. A lower CV means either the investment is less risky, meaning a lower standard deviation, or it gives higher returns, or even both, less risky and higher returns. In our example, stock C and the portfolio have the lowest CVs, so they're the most efficient investments when considering both risk and return. Now here's the cool part. The portfolio's volatility is actually lower than the average of its parts. Why? Because of diversification, especially when the assets are not highly correlated. And here's the table of the correlation matrix. We've shown this before, even how to compute for it, but now we're going to focus on this in terms of the portfolio management exercise. For example, if stock A and stock B move in opposite directions, we know that their ups and downs cancel out, reducing risk. But here's a catch. If A is negatively correlated with B, and B is negatively correlated with C, then that means A and C will be positively correlated. So in real-world portfolios, it's less about finding perfect negative correlations and more about reducing overall correlations. That's the practical side. So should we go with stock C or the portfolio? Well, even though stock C has a lower coefficient of variation, the portfolio does offer diversification benefits, as we've discussed before, and that reduces the impact of a single stock's poor performance. But here's a limitation. Standard deviation treats positive and negative swings equally. But investors usually fear losses more than gains, and this is something CV can't fix. In this sense, stock C is actually desirable despite the lack of diversification because it exhibits upward excessive surprises, which is desirable if that can be replicated in the future. So watch out for overall context always, because standard deviation measures all big surprises as risk, when in fact, big positive surprises are actually welcomed by investors. And remember, all of these numbers we're talking about here, they're all exaggerated for clarity. In real life, the returns aren't perfectly distributed or can even be modeled. They're not even observed. They'll have to be computed based on the available data. And finally, investors aren't always rational. The bottom line? Well, these mathematical tools help us understand risk, return, and how diversification can work in our favor. But they're not black box solutions. They should be used with caution and context. The point isn't to predict the future with precision. It's to build smarter strategies and reduce your exposure to unnecessary risk. Remember, robustness of results is more important than precision. So if you want to learn more about risk, returns, and quantitative finance, don't forget to check out our Value at Risk video and the others in this series which lead to that video. Like, subscribe, and hit that bell if you found this helpful. See you next time!